long topic we are going to start. Probably we will be finishing it in approximately 8 to 10 lessons with understanding the concepts and with doing a lot of practice questions. I'll start with the very basic, very basic. I'll assume that you people have absolutely no previous knowledge about consolidation, though I know that all of you people have certain knowledge from past, but I'll assume that you don't have. And I'll start with the scratch, so it means that it will take me one lesson to talk about very basics, and probably within that basics you might find something new or you might find something interesting. So we need to be patient with this topic. It's a very important topic, and I would say that it is one of the most complicated thing in your financial reporting, because this is the point where the accounting becomes complex because it involves different standards, it involves different complex calculations quite a lot sometimes. So introduction to groups, we call it consolidation, consolidated financial statements, and the standards which we are going to use will be your IFRS 10, IAS 28, business combination. We'll discuss IFRS 3. So then IFRS 9 also we will use. So 4 standards mostly, which are, and then you have joint ventures, IFRS 11. So the consolidation standards itself. Of course, during the consolidation process, there will be adjustments which will be related to other standards. Like you will have an adjustment for employee benefit IAS 19. You might have adjustment for leases. You might have adjustment for any other thing. IFRS 2 adjustment would be there. So consolidation would involve the knowledge of other standards, plus there are 4 or 5 standards typically which are related to consolidation itself. So start this thing. Let's now. Syllabus learning outcome, describe the concept of a group as a single economic unit. This is the first rule of consolidation. We say that consolidate as if it is a one company. So many times you will see the adjustments related to intragroup transactions. You will see adjustments related to intragroup sales, intragroup receivables, assets and liabilities, etc. You should always consider that when you are preparing the group financial statements, the group financial statements are presumed as if it is one single entity. Although these are different legal entities, but you will assume that it is one single entity. Explain and apply the definition of a subsidiary within relevant accounting standards. We are going to learn what is subsidiary, what is an associate, what is an investment, what is joint venture and joint arrangements, etc. We'll discuss this thing subsidiary in quite detail little later. Identify and outline using accounting standards and other applicable regulation the circumstances in which a group is required to prepare consolidated financial statements, when you should prepare, and if there are any exemptions or not. And by the way, we know that we understand group means that there is a parent company, and then there are several other companies which might be subsidiaries, which might be associates, which might be investments, and together we call it a group of companies. Describe the circumstances when a group may claim exemption from the preparation of consolidated financial statements. We will discuss. Explain why directors may not wish to consolidate a subsidiary when this is permitted by accounting standards and other applicable regulations. One common reason for not wishing to consolidate, although there are very strict criteria, and IFRS, encourages you to include everything and discourages you or prohibits you to exclude something, but still, why managers or directors may not wish? Because if a subsidiary, it is a loss-making subsidiary, and you take it into your group, so your group profits will go down because of one particular entity, and there is a valid reason behind that. That overall it would look like, for example, there is a parent company, there is a subsidiary A1, subsidiary 2, and subsidiary 3. Maybe subsidiary 1 is making $100 profit, it is making $100 profit, it is making $300 loss. When you consolidate, to be very straightforward, of course these numbers are not correct, but let's keep it very simple. So it means in consolidation is a process of addition, by the way. So 100 plus 100 minus 300 looks like that it is 100 loss. Of course, consolidation will not happen so easily. These numbers will not come like this, but I'm just making it a case. So because we know that consolidate means addition. Consolidation is a process of addition. And of course, some adjustments would be made for subtraction. But let's suppose it is addition for a moment. So it looks like that the group is making loss. Whereas in reality, the group is not making loss. Only one entity is making loss. This is one particular situation that directors would try that this subsidiary 1 and subsidiary 2, which is making 100, and I consolidate the results and 200, and then I show that there is a separate loss of 300. So, not to make the, because right now if you see that it looks like all of the group is doing bad. Reality is all of the group is not doing bad. Only one entity is doing bad. So in order to convey this information appropriately, the directors, they wish to keep it separate. This is about when you have, I would say, a loss-making P&L in the group. Another reason could be some liabilities. You might have some entity or might have some subsidiary who has got huge debts, and when you consolidate those balance sheets, so the group also looks indebted, whereas not all the entities in the group are indebted, only one is usually indebted. So these are 2 particular very common reasons that sometimes they wish to, but of course all wishes do not come true. Explain the need for using coterminous year ends and uniform accounting policy when preparing consolidated financial statements. So we will discuss this issue as well in later slides, that you might have different year endings. For example, the parent's year end is 31st of December, whereas a subsidiary year end is probably 30th of September. So subsidiary closing date or the financial statements which are available, they are on a different date than the parent. Now, very quickly, because I can close this issue here, so let me say, IFRS allows you that if there is a 3 months gap or less, you can consolidate. Like 30th September to 31st December, 1 quarter, you can consolidate. Of course, you need to make some adjustments so that you need to make adjustments for the last 3 months, and you can consolidate. This is one thing. And uniform accounting policies, which mean that you have parents and you have subsidiaries. Subsidiaries might be having different accounting policies. Parent might be having a different accounting policy. A common example is that subsidiary is using cost model for PPE, while parent is using revaluation model, for example. So then you have to use a uniform accounting policy, which is the accounting policy of the parent. And for that purpose, you need to make adjustments. And we make fair value adjustments, etc. Uniform accounting policies. Although we cannot force subsidiaries to use our accounting policies, they might be doing it. But when you make consolidation, you make adjustments for that. Explain the objective of consolidated financial statements, of course, in order, because shareholders are investing in the parent company, and you need to show what are the groups, what are the results of the overall group, because we say that as if it is a single entity. Because what happens in consolidation? You have one entity here, you have another entity here, and you have another entity here. These are 3 different legal entities. This could be a bank, this could be an insurance company, this could be a construction company. All 3, they are within the same group. So when you prepare group statements, you actually put all 3 of them under one roof. You assume that they are in the same house. So this is a concept when you say that remove or ignore intragroup transactions, because any transactions which happen between them, those transactions do not go out. They remain within the same house, under the same roof. So we assume that for individual company, this transaction has taken place, but for the group, the transaction did not take place. For the group, only money transfers from, if the goods were sold from this warehouse to this warehouse, or the goods moved from this warehouse to this warehouse, but end of the day, these warehouses are still under one roof. So we assume that it is like one single entity, and the results of that one single entity. Explain why it is necessary to eliminate intragroup transactions. I just explained to you with the help of that figure that intragroup transactions within the group companies, they're actually lying under the same roof. So those transactions in reality for the group, they did not happen. Like when I said that this company, it sold goods. So for example, this is one entity which is selling goods. A sells goods to B. For A, the sales exist because A will say, I sold the goods I have dispatched. B will say, I purchased the goods because I received the goods and I paid the money. So A will record sales and B will record purchases. But the group will not record the sales and will not record the purchases because for the group, these transactions do not exist. For individual financial statements, these transactions will be shown. In the individual financial statements of A and in the individual financial statements of B, you will show this transaction. But in the group financial statements, this transaction must be eliminated. So we say why it is necessary. It is necessary because we assume as if it is one entity. Okay, so chapter summary, what we are going to discuss actually here, if I see. So introduction to groups, concept, parent separate financial statements you make. Like I said, that parent will make its own financial statement, subsidiary they will make a separate, and then for the group you make together. So you might have a parent income statement, you have a subsidiary income statement. These are different income statements. They will make it, and then for the group you make together. So this is going to be the third one. Group financial statements, of course, all of the financial statements, group statement of profit and loss, statement of financial position, cash flow, equity statement, etc. Definition of a subsidiary. We are going to spend quite a lot of time on this thing in the coming slides. This is an important topic, and non-controlling interest concept. So these are the things which we are going to discuss today. Okay, so I'm just kind of giving you or revising with you the very basics of consolidation, so that when we move to the second lesson or third lesson, I do not have to assume that you should know it, because in second lesson I would know that I have already explained you this concept. So companies may grow organically or by acquisition. And this is something which will happen a lot. Where companies grow by acquisition, they acquire control of other companies. For us, this word is going to be very, very, very important word, because there are going to be different methods of consolidation. You might have consolidation, one method, second method, whatever. And all of these things will depend on your control. So it's very important, control. And we'll understand what is control. So when companies grow by acquisition, they acquire control of other companies as below. So shareholders, ABC Holding PLC, it acquires 100% of ABC Professional Services. It may acquire 95% of ABC International Limited, and it may acquire 51% of ABC Online Services. Okay. Pay attention that all of these are more than 50%. The significance is all these are more than 50%. Now, what does that mean more than 50%, and what implications it has? We are going to discuss now. So the method used to account for the acquisition of shares by one company in another company depends on the type and extent of the investment acquired. How much investment you have acquired? 80%, 90%, because generally speaking, these are different cases. Like 60% you make investment, or you acquired 60% of another entity, or 40% of another entity, or 15% you made investment. These are, generally speaking, they will create differences in consolidation. I'm using the word generally because I don't want to use the word always, because sometimes there are some exceptions, and we are going to discuss those exceptions. So it's very important to see that how much investment has been made, which means that what percentage of shares you have acquired. And when I say percentage of shares, I'm actually talking about the voting shares. Voting shares we are focusing on. And voting shares means your equity share, which means that preference shares we will just ignore. Our focus will be on equity shares. Like I said, that you acquired 60% shares in some entity. So the question is, are these 60% equity shares or are these 60% preference shares? Principal terms to be aware of are investments in subsidiaries and investments in associates. These are two different scenarios, subsidiaries and associates. Let me just go to the next slide and I will show you exactly, and then I will start explaining from there. My slides, they show it. I will go back and revise. Let me first tell you, because I'm just talking about this 50% stuff, so I need to clear it here. So I just skipped a few slides. I will go back to them. You see it here. The first thing which you need to establish when you acquire another company or you invest in another company, what you are always looking at, that as a result of this acquisition, did you get control or not? Did you get control or not? And how the control can be achieved? The control can be achieved in certain situation. The most popular scenario is where you get more than 50% rule. If you get more than 50% ordinary shares, voting shares, equity shares of another entity, it is said that you have got the control over that entity. And what does control mean? Control means that control over the operating decisions, control over the decision making of that entity. So you got a control. If your investment is 50%, greater than 50%. There are some exceptions as well, which we are going to discuss today. But to start with, you should remember that if you acquire more than 50% of voting rights shares, you get control. If you do not get 50%, you invest less. And the rule is 20 to 50, like 20%, between 20 to 50%. You don't have control. For example, if you acquire 30% shares in some other entity, which means that out of 10 directors, you can only appoint 3, you cannot control. You cannot control because you have got 30% voting rights, or you have got authority to appoint 30% of the directors, which means 3 out of 10. You cannot control. But what you can do, you can exert significant influence, because you have people speaking in the boardroom. You have this, how to say, capacity to influence the decisions. This is called now associate, which means that if I have a parent here and they invest 80% in company S and they invest 40% in company Q, I would say that S is a subsidiary and Q is an associate. Q is an associate, and there are different accounting standards for that. For subsidiary, you use IFRS 10. Previously, it was IS 27. For associate, you use IS 28, and the accounting methods are called full consolidation, which is also called line by line consolidation. And actually, I would call this is the real consolidation. Okay, this is the real consolidation. The other one is called equity accounting. IS 28. When I say full consolidation or I say line by line consolidation, it means that I will take the parent's income statement and the subsidiary income statement. I will start adding the lines, which means revenue of parent plus revenue of subsidiary, cost of sale of parent plus cost of sale of subsidiary, admin expense of parent plus admin expense of subsidiary. If I go to balance sheet, PPE of parent plus PPE of subsidiary. So line by line consolidation, which is called full consolidation. And this is what you say consolidation at its best. This is the most actual real consolidation. In case of equity accounting, like if you have less than 50% thing, you don't do full consolidation. You use equity accounting, which is IS 28. And in IS 28, what you do, you only take your profit share. You see that what is the profit which subsidiary has made? Subsidiary made 100 million in profit. How much you own? You own, let's suppose, for 30%. So out of 100 million, you say, okay, 30 million belongs to me. So you take the profit and you only consolidate the profit into your financial statements. You don't bring subsidiaries assets to your balance sheet. You don't bring subsidiaries liabilities to your balance sheet. You don't add, associate. Sorry, the word associate. You don't add associate assets and liabilities to the parent's asset liabilities. Never. You do not add associates revenue to parents revenue. Never. Because we are not doing line by line consolidation in this case. We only will say, this is my associate, how much profit it has made. They made 100 million or 10 million, whatever. If they made 100 million, 30% belongs to me. Give me my profit. And I take that profit and I put it into the group consolidation thing, group financials. So these are the two things. And by the way, why do you not do? I always say that, okay, these are the rules. And I don't say you to remember the rules. You should have a logic that why this rule is there. Why I am not doing full consolidation. Why I'm not adding up to income statements here. Why I'm not adding up to balance sheets here. The answer is, why should I? I'm not controlling this thing. It is an associate. I am not controlling. If they have liabilities, why should I take their liabilities into my balance sheet? I did not take the decisions. Yes, in case of subsidiary, because the parent is controlling, so parent takes responsibility. And therefore, as a result of those decisions, which the parent has taken as a result of this control, the impact of those decisions is reflected in the financial statements, and the parent should take the ownership. And therefore, you should do line by line consolidation, because it was under my control. I take the ownership of whatever good or bad financial statements are, and I will consolidate them into or with my own results. So these are three examples which I have mentioned here. The fourth one is less than 20%. When you have less than 20%, less than 20% is called investment. It is called financial interest. It is called financial interest, and you use IFRS 9 here. Financial instrument. You purchased some entities, 3% shares, 5% shares. I don't know, 10% you made investment. You purchase some bonds in some other entity. I'm sorry, not bonds, shares we are talking about. So you purchase shares, but your investment is only 3, 5, 7, 8, 10%. It is less than 15%. Now you don't have significant influence. If you own 5% of some company, what kind of influence can you exert? You don't have any influence at all. It's just an investment. You purchase it today, you will sell it tomorrow. So we'll deal with here IFRS 9. There is one more scenario which we will discuss, and that would be joint arrangements, and IFRS 11 would be there. But I will do that once I complete all three of them. This I will keep in the end. Any questions until here if you want to ask? Okay, so we got familiar with these terms: subsidiary, associate, control, 50% rule. Now the question is that does control come only with 50% rule? The answer is no. Control can come with greater than 50% ownership, or it would come with the under a contract where you made a contract. You might have 40% ownership, but other shareholders, they have agreed that you will manage and run the business. You have the control. So you might have 40%, or you might even have 30%, but still you can control because there is an agreement. This is by default, which you get. This is by agreement you get. And sometimes you might have some other situations, which I will discuss now. Just you need to wait for that. So control comes from 50%, it comes from contract, and it comes from some other situations as well. Now let me go back. I skipped a few slides, and let's see what we skipped there. So okay, so this was where we skipped. Definitions. Subsidiary, an entity that is controlled by an entity. Now we are clear about this definition, that when subsidiary means that control exists. If there is no control, there is no subsidiary. Subsidiary, the word subsidiary will only use when you have control over some other entity. Control, what is control? An investor controls an investee if and only if the investor has all of the following. There are three criteria which are given by IFRS 10, and these criteria are given by IFRS 10. Number one, power over investee. Number two, exposure or has rights to variable returns from its involvement in the investee. And number three, the ability to affect those returns through its power over the investee. So this is actually this is the output. This is the outcome. Control means these three things. And when these three things will happen, they will happen when you have ownership of 50%, or you have a contract that you will manage the business, whatever. So these are the outcomes, that you have the power over the investee, and you have the ability to affect those returns, and you have a right to some variable returns. Variable returns are what? Remember, debt does not give you variable return. Debt gives you fixed return. When I say variable return, it means that I have equity shares inside this company, because variable returns would be dividends, which might go up, might go down. And those dividends, or those changes in share prices, dividends, whatever, like you say residual interest is not a fixed amount. Residual interest means that you pay everyone everything, whatever is left, that is yours. That could be more, that could be less. Variable returns, and the ability to affect those returns. So if you are taking the decision, you have the ability that these returns may go up or may go down. So this is ultimately what control gives you. What control gives you. How control is achieved, the three situations: 50%, contractual agreement, or maybe some other situations. Examples of rights that either individually or in combination can give an investor power. So power can come individually or in a combination. It could come in a combination as well. So rights in the form of voting rights. Preference shares do not have a voting right. Only the equity shares, only the ordinary shares, they have a voting right. So we are speaking about the voting right shares, which means the ordinary shares. Right to appoint, resign, or remove members of an investee scheme management personnel who have the ability to direct the relevant activities. You might not have 50% or 55% of shares, but you have a right to appoint directors. You have been given under contract that you've got 30% ownership, but you will appoint the directors. So this is called right to appoint, and that gives control, by the way. That brings you control. Right to approve, appoint, or remove another entity that directs the relevant activities. So either the directors or some other entity. Right to direct the investee or to enter into or veto any changes to transactions for the benefit of the investor. Again, it looks like that you are getting control through this number 4 point. and other rights such as decision-making rights specified in a management contract, etc. Parent, the top one, parent is many times you call it a holding company, a parent, a conglomerate. These are the different words which we use. So parent is the ultimate owner. Parent is the ultimate owner. So parent, an entity that controls one or more subsidiaries. Group is a parent and all its subsidiaries all together. Associate, I already have explained, where you have a significant influence and you don't have the control, but you have investment between 20 to 50% range. Significant influence, they only participate in the financial and operating policy decisions. They do not control, but they can exert influence. And we call them associates, IS 28 equity accounting. I already have explained this slide. Control under IFRS 10. Now, I'm just going to explain this control issue a little bit more because sometimes they give you a scenario which is very obvious that control is there. But sometimes you get stuck that do we have control or not? Because once you make a wrong assumption, once you make a wrong decision about control, your total question will be wrong because your method of consolidation will change. If there is control, but to you, it looks like that there is no control. You think that there is no control. So if you think there is no control, you probably are going to use a different standard to consolidate, IS 28 maybe. But in reality, there was control which you could not understand because the situation was slightly complex. So your question will depend a lot on the first step when you decide, do I have the control or not? That is the starting point. You make this decision wrong, entire question will be wrong and you will get, I think, zero, probably hardly anything in some other area. So control exists when an investor has all three of the following elements. Remember all three, and these are the same: power over the investee, exposure to variable rights, and the ability to use its power over the investee to affect these variable, the amount of investors' returns. So these are the three criteria I discussed before. You see them here. This is ability to use power to affect return, variable returns, and power. These are the power over the investee, ability to use the power and to influence the variable returns. Now, let's see certain situations. Like I said, that sometimes they create some complications where you find it difficult to identify the relationship. What is the relationship? We'll discuss many of these examples one by one. For example, largest investor holds only 48%. So it means that clearly they're not more than 50%. So 50% rule will fail here. According to 50% rule, they don't have control. But then we say holding of remaining investors. So 52% are so holding of largest other investors. There are no other large investors. Rest of the 52% is distributed as 1% between many other, like maybe between 52 other people. And none of these shareholders have arrangements to consult each other to make collective decisions, which means that these 52 shareholders who hold 1%, they will never get together and join hands to beat you down. You are in control here. Control, it exists. Although you've got only 48%, but the other side have very little, like 1%, and they cannot, join hands together against you. So you are in control of the entity. Another example, 40%. 12 investors hold 5% each. So 40% you have, remaining 60% is divided among 12 investors, everyone holding 5%. Now let's read this condition because this is the scenario which they will give you, or they might give you in exam, this type of thing. A shareholder agreement grants the largest investor, the right to appoint, remove, and set the compensation of management responsible for directing the relevant activity. So they've got 48%, but they have got the contractual right to appoint directors. A 2/3 majority shareholders vote is required to change this agreement. But this agreement, it exists, but it can also be changed by 2/3 majority. So yes, control exists because of the agreement, because you have the right to appoint directors. Not conclusive if considering only the voting rights. Voting rights you do not have. And how this agreement can be changed? A 2/3 majority shareholder vote. Whoever are present in the meeting, 2/3 majority shareholder vote. If they can bring shareholder vote 2/3, this agreement can be changed. If this can be removed, you will lose control. Next example, 45% you have. There are two investors hold 26% because 45 you have, and two investors with 26, which makes it 52%, and then three investors, they hold 1% each. There is no agreement here, and there is no control because these three people can come together. These three people can join hands, and they will beat you out of the room. You don't have control. No control exists because there is no such agreement available. Again, you have got 45% like above. This time there are no other big investors, but there are 11 shareholders of 5% each. None of the shareholders have arrangements to consult each other or make collective decisions. Not conclusive if considering only voting rights. So if you consider only voting rights, not, but otherwise it is yes. Otherwise it is yes. If these people, they do not have the authority. Okay, last one, 35% you have got. Next three investors hold 5% each, which means 15% here. Numerous shareholders less than 1%. So 35, 15, 50, remaining 50% is here with even less than 1%. There might be hundreds of shareholders lying here. None of the shareholders have arrangements to consult each other or make collective decisions. Decisions made based on majority vote. 75% of the votes have been cast at recent shareholder meeting. 75% of the votes. You have only 35%. So it means that again, you cannot control because although shareholders cannot consult with each other, but the thing is that decisions made based on majority vote. The article says that the company decisions will be made by majority vote. And if you talk about majority vote in last meeting, 75% was there. 75% of votes have been cast. You are not in control. You have got 35%. You're not, out of this, it looks like that you are 35 and others are 40. You clearly are not in control. So these are some examples about control when it exists. I mean, different, like I just explained to you, I think a little bit of too much. Probably they will not go into so much depth in exam, but it's a good exercise or it's a good knowledge to have. Let's do one short question here. Question is about control. Which one or more of the following would be accounted for as a subsidiary of A? A holds no shares in B. So the different entities B, C, and D. A holds no shares in B. However, through an agreement with B's shareholders, A chooses 6 of the 10 board members. Definitely, this is a situation of control. Yes. Because A does not have the shareholding, but A can appoint 6 directors out of 10. So 60%, which means that whatever A will decide, that will happen. Number 2, A owns 45% of C's shares. No other individual shareholder owns more than 5%. Everybody is less than 2, 3, 5%. Again, you have control here. Although your holding is still less than 50%. And that's why I say that by default, you get it 50% plus. But there are exceptional situations as well, which we are discussing here. A owns 55% of these shares. Under contract, in place, A must make all decisions in agreement with E, who owns 45% of the shares. That is called a joint arrangement, because you have to make all the decisions in agreement with E. So it means that you don't have control. A does not have control. Although A has 55% ownership, but A cannot control the activities. The decisions related to operating and financial policies, they will be made together. Number 4, A controls F, a partnership under an agreement. It's a partnership thing. We are not talking about partnerships here. This also is gone. So if I see if they have given the answers to this thing, should be A and B, I suppose. Yeah, A and B. A and B. Number 1 and number 2. I mean, situation number 1, point 1 and point 2, you've got control. Partnership is beyond the scope of what we are talking about.